Okay, picking up where we left off, we were going to look at an income statement that used the horizontal analysis. Okay, so looking from 2015 to 2016, our sales went up by $298,000, and then our percent of increase, take the 298 divided by the 1.2 million, the base year, the oldest year, and we have a 24.8% increase. So that is really good that sales increased by that amount. Okay, and then if you look at your cost of merchandise sold, this is not a good thing here because it went up by more than sales went up. So that is not a favorable trend, and that is a red flag there. So what this is saying is I sold it for a higher price, but not enough to cover the increase in the cost of the goods sold. But we would really need to take a look at that number because we wouldn't want that to continue to increase that much. But if you look at gross profit, gross profit did go up, and it did increase by 19.7%. So that's good. We still have a good increase. We would really have to keep a watch on this and see what's going on, because we can't continue to go increase by that percent. Okay, and then if you look down, we can see that operating expenses and selling expenses went up a lot. So that's something you would definitely want to look at too. You don't want your expenses going up too high from year to year. This one is a good one. Maybe we paid off a bond because our interest expenses went down by 50%. So that's good that we've gone down on that expense. So you would just go through and look at these items and look for potential red flags of things that we need to take a closer look at to see what's going on. But notice that sales are in the millions. Okay, so they're going to have a bigger impact on the company than some of these smaller numbers down here, these expense numbers. They're still pretty small. So sales is one that we really want to look at, and cost of merchandise sold, because those are our big numbers here. And so we would look at those more closely than some of these smaller expenses. So when you look at this 50%, yeah, we went down, but it's only by 6,000. We went from 12 to 6,000. So that is really not, even though it is a big percent change, when you're looking at the overall income statement, these are small numbers. So we're not going to look at those as closely as some of our bigger numbers. So then what I really want to look at too is net income. That's a very important number. And you can see that it increased by 19%. So when we compare 2015 to 2016, we have a good increase in net income. So when you perform a horizontal analysis, you're looking closer at the numbers and really analyzing what has changed and why some of these numbers have changed. And here's a horizontal analysis for the balance sheet. You'll do the same thing. You'll take the difference divided by the base year to get your percent increase or decrease. If it's an increase, it'll just be a positive number. If it's a decrease, it'll have parentheses around it. I do want to mention, if you're performing a horizontal analysis for for a period of more than a year, instead of saying from 2019 to 2020, you're performing an analysis of a period of 4 years. Okay. Now, this is not in this textbook slides. This is in the previous textbook slide. But this is called trend analysis. And it is a form of horizontal analysis. And you're going to take any period amount and divide it by the base period amount, the oldest year, and times it by 100 to get your trend percentage. So here, Smart Touch Learning's net sales revenue was $750,000 in 2016 and went to $858,000 in 2020. So if you wanted to calculate the trend percentage for each year, if you did the base year, the amount is $750,000 divided by the base year, you would get 100% because that's your base. In 2017, to get the percentage, you take 748,000 and divide by the base year, 750,000, and you get your percentage 99.7%. So here it says if you do the 748, which is what we just did, divided by the 750 and times it by 100, you would get 99.7%. So trend analysis is a horizontal analysis of a period of more than 1 year. So when performing a trend analysis, the base year is going to be 100% because it's just itself divided by itself. Okay, now we're going to move on to the vertical analysis. Remember, vertical analysis is up and down. Okay, so to calculate the vertical analysis, you're going to take any specific item in your financial statements divided by the base amount times 100. So in a vertical analysis, the base amount for the income statement is always going to be your revenue. So whatever your revenue amount is, that's going to be your base amount. So here you can see that your base amount is always going to be sales or net sales revenue, whatever your revenue account is. They may call it different, but that would be your base amount for a vertical analysis. So here your sales is always going to be 100%. Okay, and then your cost of goods sold or cost of merchandise sold is going to be a percentage of your sales. So every item would be divided, your base will be sales for year 2016 would be the 1,498,000. Your base amount for 2015 items would be the 1,200,000. You would divide each one of these by that number. So what does this mean when we look at cost of goods sold? Our cost of goods sold for 2015 cost us 68.3% of our revenue. If I look at 2016 at my cost of goods sold and I divide it by the sales for that year, I can see that my cost of goods sold as a percentage of sales went up. So it's costing me more, a higher percentage amount than it did, so it's going up. The percentage of sales is not much different, so it's not necessarily a bad thing, but it may be something that could be a potential red flag if it continues to increase. So you could go down this and do any of these. If you did administrative expense, okay, you would do 104,000 divided by sales, 1,498,000. Divide it and then times it by 100. And administrative expenses represent 6.9% of our sales. And that is the vertical analysis because we are looking at items up and down. We can do the same thing for a balance sheet, but our base will always be total assets. You could say total assets or total liabilities and stockholders' equity because they are the same. Because remember, in a balance sheet, these two numbers have to match. So, 550,000 divided by $1,139,500, you would get, times that by 100, you would get 48.3%. So current assets represent 48.3% of our total assets. So you can see that current assets and property, plant, and equipment are bigger percents, and so they make up a majority of our total assets. 48 and 39%. So they do need equipment in this business a good bit. So some businesses or companies won't have as much of this, depending on what kind of business it is. Think about a service company, maybe a law firm that provides legal counsel. They probably won't have as big of a percentage for property, plant, and equipment as something that, like a manufacturing company. So a law firm wouldn't need as much. They could even rent their building and they wouldn't need a lot of property, plant, and equipment. They would have more expenses such as salaries. So this percentage would be lower for them. Now we're going to look at common size statements. And this is going to use what we just learned, and all items are going to be expressed as percentages. So there will be no dollar amounts on a common size statement. And this is useful when you're comparing one company with another, or when you're comparing a company with the industry averages. A benefit to common size statements is you can compare two different companies that may be totally different in size. So let's say these two companies are different in size. So instead of looking at numbers, we can look at percentages to compare them to see how well they're operating. So if we compare Lincoln Company and Madison Corporation, doesn't matter their size, we can see that they're both spending about the same percentage in cost of goods sold compared to their revenue. And you can see that they're pretty even on just about everything. There are a few that are a little bit different. Expenses, it looks like there's Lincoln Company's expenses are a little bit higher as a percentage of sales. It may be the sales price. Maybe they're selling it over here. They're selling it for more, so the percentage of expenses is less when compared to the total sales. You can see, though, that the bottom line, Madison Corporation's net income percentage of total sales is a little bit higher, but for the most part, they're pretty close. What's important to note is we can really compare these two regardless of what their sales are. Lincoln Company's sales might be 100,000 and Madison Corporation might be 5 million. So if we saw those numbers, it would really be hard to see how well they're doing and how to compare them. But when we change it to percentages, we can really compare these two. This is something that is not on the current textbook PowerPoint slides, but I wanted to talk about benchmarking. It is the practice of comparing a company with other leading companies, and there's two types. You can benchmark against a key competitor, like maybe Netflix to Hulu, or you can benchmark against the industry average. So here we're benchmarking Smart Touch Learning against Learning School, and this is